Rahim. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
Waalaikumsalam warahmatullahi wabarakatuh.
Waalaikumsalam.
Very good morning, dear sisters and brothers. See you again on the 12th meeting of Banking Financial Management, 5th semesters. I think you have already seen the slide that I have shown in the screen. And as I mentioned last week, that we're going to learn about some related risks that you have already studied before. So on the 8, 9, and 10 meeting, you have read and learned about credit risk, market risk, liquidity risk, and also operational risk. And now we are trying to summarize and accommodate all these risks into a single picture, so it can comprehend you in details and more about some risks related in Islamic banking. And now we just move to the slide. I will share the slide later on in my class. And meanwhile, if you have some question and inquiries, please don't hesitate to just interrupt me. Okay, sisters and brothers, sorry for having the class a bit earlier than scheduled because of unintended plan today. We will have some meeting with the dean. So rather than I just make you waiting for a long time, and better for make me be earlier than before. Okay, you just move to the slide, sisters and brothers here. So now we try to look at the practical applications of market liquidity, credit, and operational risk. Yeah, on banking sectors, either conventional and Islamic banks. So in general, dear sisters and brothers, either Islamic or conventional bank, they have similar and quite close in terms of the characteristic of the risk. They also have market liquidity, credit, and operational risk because they are operating under the same system, namely the conventional system. So Islamic banks, even though they are Islamic, but they are still in the very small portions or a share compared to the banking sectors in general. So we will try to look at the details in terms of the characteristic of respective risk in the Islamic bank and conventional banks. And here, so we try to look at the market risk, liquidity risk, credit risk, and operating risk. And we'll look at the practical application a bit of the respective risk. Okay, this one, sisters and brothers. First of all, we try to look at the market risk. So the market risk here actually related with the unexpected loss or returns that's coming from the external factors, namely the market fluctuation or volatility. So if you look at in the practice of conventional banks, we'll try to understand that conventional bank deals with the interest rate risk, deals with interest rate, exchange rates, yeah, and also deals with some macroeconomic conditions such as economic growth, rate of inflations, yeah. So those changing environments, yeah, will affect the market risk of the banking sectors, yeah. So here, if you look at a bit definition of the market risk, so we recognize about the market risk premium. Yeah, premium. We will add the details later on. What is premium? So the market risk premium is the additional returns and investors will receive or expect to receive from holding a risky market portfolio instead of risk-free asset. So you see, sisters and brothers, in the banking sectors, the main activity is collecting fund and channeling into productive activities through credit or financing. So on this regard, these operational risks, these operational activities of the banking sectors will make the bank hold some assets. You see, what are the assets? The first asset that the bank will hold or receive is the cash. So if you are the customers or depositors, the money that you put in Islamic bank will be the asset of the banks. Yeah, because the bank will use your deposited fund to be channeled into credit. Yeah, so this asset that the bank hold, actually can be categorized into risky market portfolio, or risk-free assets. Yeah, there are two different type of assets. Yeah, sorry. Okay. The second one, if you see from the asset characteristic of the banks, we recognize about risk-free assets. So risk-free assets mean that the asset that has no risk. For example, government bonds or government obligations, the government debts. So those examples are considered to be risk-free assets. What does it mean? It means that the return of holding of this asset will be no longer fluctuating over the time, because the government has guaranteed that this asset will no longer up and down due to the market activities or the market fluctuations. Differently, if you holding an asset in terms of the uh, for example, machine, for example, or maybe capital, or maybe portfolio management, for example, stocks, for example. Yeah. So those examples are fluctuated due to the market activities. So this market premium tries to compare and contrast whether a bank should hold a risky market portfolio or a risk-free asset. So the market risk premium is part of the capital asset pricing models, or CAPM. So if you are going to look at the risk premium, due to the market activities, you can look at the capital asset pricing models, which analyzes and investors use to calculate the accepted rate of return for an investment. So CAPM is the concept of risk volatility and rewards. So investors always prefer to have the highest possible rate of return combined with the lowest possible volatility of returns. So you see from this CAPM system, brothers, there are two opposite directions of the asset invested. The first is about return, and the second one is about risk. So risk and return somehow is in the opposite directions. Yeah. So the investors, you and investors expects get high returns but low risk. Always like that. Yeah. There is some investors that want to get high risk, high returns, but because of you are maybe risk avoiders, you don't like risk very much, so you just want to the risk is lower but the return is high. So in order to measure to what extent the risk accepted and the return expected, so you can use the CAPM. And here is the graphs, basically, sisters and brothers. Yeah. So the vertical axis here denotes the returns in percentage, and the horizontal line here is the risk due to the market. So these two opposite line, will show you to what extent the degree of accepted risk that you want to hold. Here you have the orange color here that is denoted as the risk premiums. So the risk premium basically is the difference. Yeah. So the rate of the risk premium basically is the difference between the market returns and risk-free rate. So risk-free rate here normally is horizontal lines. The shape of the risk-free asset usually is the horizontal line. What does it mean? It does mean that whatever risk happen in the market, I repeat again here. So usually the risk-free asset, the shape is horizontal line, horizontal here. Look like this one, horizontal axis. So what does it mean by the horizontal line of holding the risk-free asset? It means that whatever market conditions, whatever market fluctuation happen, so you no longer have the fluctuation in terms of the risk, in terms of the return, sorry. So whatever condition, your return remains constant. That is the asset in the form of a government obligations or government debts. Therefore, if the government offers some suku, for example, yeah, and also government debts, the degree of selling is quite fast. So everybody is convinced that the debt given by the government will be guaranteed, so that everybody tries to purchase the asset very fast, because of this instrument is considered to be risk-free asset, risk-free rate. Whatever market condition happens, no longer changing in terms of the returns, the same return. For example, you are promised to get a return for 5 years, 10%. So until 5 years, your return will be remained 5%. But differently, if you holding an asset is not considered to be the government debt, for example, stocks. I think everybody here is has been understood about stocks. So the stock here considered to be not risk-free asset, but this is the fluctuating asset. Yeah. So it will be changing in terms of the return according to the condition on the markets. Yeah. So here, by comparing the market returns and the risk-free asset, so you will get here the risk premium. So the risk premium here is the difference between the market returns and the risk-free asset. So the more different the gap here happens, of course, the investors will look at the portfolio. So if the portfolio is higher, the gap is higher compared to the risk-free asset, so the investors will look for this portfolio. The next one here is what is the market premium also. So we here differentiate into 3 aspects of the premium. Required market risk premium. Required market risk premium is the minimum amount investors should accept. Yeah. So on this regard, required market of return can be here. Risk-free asset. This is the minimal amount. The minimal amount that the investors will get if he holding a particular asset. Yeah. And the second one here, the historical market premiums. A measurement of returns past investment performance taken from the investment instrument and blah blah. So it means that it is based on the historical assessment. So what is the previous return that has been shown by the maybe here in case of banking performance. So the investor will look at this as the references. And the third one is the expected market risk premium. Yeah, expected. So based on the investor return expectation. So expectation means the investors tries to project and estimate or forecast that the future estimation of the return will be better compared to existing return. So the expected market risk happens to be positive, yeah, because the investors expect that he will get return more compared to existing conditions. And the next one here, here's the formula, sisters and brothers. So how to calculate then? So the market risk premium is expected rate of return minus risk-free asset. So expected rate of return is always positive. Positive means it also higher compared to existing conditions because we expect better compared to before. And the risk-free asset here represents the benchmark, the lowest required returns that investor will get. So from this one, the market risk premium is expected to be positive always. Yeah. For example, the S&P 500 generated a return of X% of the previous years, and the current interest rate of the treasury bills is 4%. Yeah. So the 8% here represent is for the expected rate of return. Yeah. And the 4% here represents the risk-free asset. Risk-free asset means the basic, the benchmark required risk and return that will be obtained by the investors. So if you are asked to look for the premium means the additional return that investor will obtain through holding a particular asset is the difference between 8% and 4%. So this 4% will be the consideration of the investors to hold this asset. Yeah. So if you summarize from this part, sisters and brothers, so in the case of Islamic bank or conventional banks, the premium rate will always be the risk happened due to the changing activities in the market environments. So in case that the risk premium is positive or higher compared to the risk-free asset. Risk-free asset means government bonds, for example. So it will attract more investors or depositors put the money in the banks. Yeah. So I repeat again here: if the risk premium is getting higher and bigger, yeah, time to time, so it means that the investors are attracted to hold bank asset through depositing the money in the banks. And the vice versa, if the risk here is getting getting narrow or smaller time to time, so it will expel, yeah, or will make the investors withdraw the money and change the money that they obtain from the bank into another asset, for example, bonds or government obligations. So, of course, this market condition in conclusions will affect to what extent the market risk will affect the balance sheet of the bank. If the market risk can be reduced or the risk premium getting higher, so the balance sheet of the bank will be surplus. Bank has huge money to be lended, but the way around, if the market risk getting higher and higher, yeah, so it means that the risk premium getting smaller, so it is has possibility for the depositors or investors to withdraw the money from the bank, so that the balance sheet of the bank could be negative or deficit. Yeah. So this is the first part of the risk in conventional bank or Islamic banks. Maybe you have any questions, dear sisters and brothers, or you have any clarification, most welcome. Okay, if you don't have any question, you just continue. Next one. So the second part, we are going to discuss about liquidity risk. Yeah. Um, so here we move to the next risk embedded in the banking sectors, namely liquidity risk. So if you can read from the exam of the definition here from the slide, is the liquidity risk is the risk that company or individuals or the bank, including, will not be able to meet short-term financial obligations due to inability to convert asset into cash without incurring a loss. So from these simple definitions, you can imagine that the liquidity risk happens because the bank cannot pay back the financial obligations to the investors or um, depositors. The bank's inability is due to unable asset to be converted. So the asset may be initially in the form of debt obligation or stocks, for example, yeah. And in the end, the bank cannot convert this instrument into cash. You see, sisters and brothers, the bank receive money from depositors or investors. Yeah, for sure, the bank must pay back this money if depositors wanted to withdraw. Surely, it depends on the instrument of the banking, either demand deposit or time deposit or saving deposit. But overall, all the accepted money from depositors or investors must be paid back by the bank anytime. Yeah. And the problem somehow, the bank use the money from the depositors or investors to be invested to another activities, lending, yeah, or buying instruments, yeah, buying the bonds from the government, yeah, buying the stocks from stock markets, for example, and buying currency from currency market. So whatever uh, investment instruments available in the markets are taken by the banks in order to have additional profits or additional revenues or income to the bank, and this revenue and profit obtained through the financing is expected to be able to be paid to the depositors or investors when they are withdrawing the money. Yeah. And the problem happens somehow once the bank invested the money in the instruments, yeah, of financial instruments such as stocks, bond, and others. So in logical understanding, the money that the bank holding, yeah, is lacking because the money has been invested to another instruments, and suddenly, for example, the investors or depositors withdraws the money. For sure, the bank must fulfill the intention of those investors and depositors. But the problem happens because of the bank must pay them, yeah, not in the form of invested instruments such as bond and stock, but must be paid them in the form of cash because they put the money in the bank in the form of cash. Yeah. So when the bank cannot be able to convert the existing or the holding instruments into cash when the investors and depositors are intending to withdraw the money, so it will incur the liquidity risk. Yeah. So how does the liquidity risk works? Yeah. So here I have mentioned before there are some factors. The first is here inefficient markets. Yeah. So the market is not efficient to generate income, yeah, from the invested instrument of a bank. In other words, the profit or revenue is not as much as the expect by the banks. Yeah. And the second one, limited cash flow. So the bank has already put the money very large to another instruments. So the bank no longer has enough money in the account. So the bank cannot pay back the withdrawals. And the market structures, yeah, here can vary in terms of depth, weight, and size. Yeah. For example, in the case of, maybe you remember Century Banks, yeah, Century, yeah, the bank Century. The bank Century is bankrupt, yeah, at the moment, and created systemic risk due to the complication of the operation of these small banks. So even though Century Bank is very small, but it has a network, yeah, to other banks, big banks. So once the Century Bank collapse, so it will affect to the connected banks. Yeah, they're dealing with its Century. So this dealing with the market structures. And the asset type here, the asset type, whether longer, yeah, long, medium, or short-term asset, and urgency, yeah, urgency. And the last one, market conditions, yeah, the market conditions. And the next one, here the examples, sisters and brothers, of liquidity risk. If I can read just slowly, company ABC, yeah, company ABC is a trucking business, yeah, that operates out a large Midwestern warehouse. Its margin are thin, so it doesn't hold much cash. Yeah, but it has a second unused warehouse that is valued at 250,000, and it currently has 10 trucks that cost 10,000 each. And in order to meet the monthly commitments to its client, it relies on all of them being fully operational. You see that there is an unused warehouse, yeah, and also it has more trucks for operations. And here the explanation is, on the way back from the delivery, one of the drivers get into accidents. Yeah, so we continue the story, and the truck is totaled. Yeah, the company's insurance provider is trying to deny the claims. So the company does not expect to receive a payout for at least 4 months. With all, the company still needs to deliver on its monthly commitment, but cannot do so with the only 9 trucks. You see here, there's a problem of 1 truck, totally unused due to accident. And the company must now purchase a new truck for 100,000, or they risk losing their contracts. They don't have the cash on hand, so they must sell off their second warehouse in order to meet their obligations. However, there aren't many buyers, you see here. So in order to purchase a new trucks, the company must sell the second warehouse. But the problem is there aren't many buyers for the warehouse. So they are forced to sell it to the highest bidders at a loss, or they will fail to meet their monthly commitment to the client and lose their contracts. Since company ABC cannot meet its financial obligation without incurring a loss from the sale of its asset, it is experiencing liquidity risk. Yeah, you can imagine here the story. Yeah, the liquidity risk means inability of the company or the banks to meet the financial obligation to the second parties, because the asset available cannot be converted into cash, so that the obligation cannot be paid back because of the asset cannot be sold. Yeah. So here the second about the liquidity risk, and here the types. You can just read by your own letter. So we have liquidity risk here according to the depth, weight, and resilience. Yeah. But overall here, sisters and brothers, by the way, liquidity risk happens because of the mismatch. Yeah, my conclusion here is the mismatch between the asset and liability. Yeah, so the asset here cannot be converted into cash, so that the obligations of the company or the bank cannot be fulfilled. So the mismatch between the asset and liquidity, mismatch between the cash received and the cash out. Yeah. So here is the essence of liquidity risk. And how to manage here liquidity risk? There are 4 steps. Yeah, forecasting cash flow. Yeah, so you have to be able to forecast when the cash flow will be started, whether this month, next year, or when. So by having this forecasted cash flow, so we have a plan to manage when you have to sell your asset, or when you have to provide your cash and others. And second one, comparing asset and liabilities. Yeah. And the third one, creating a buffer between earning and expenses, meaning that you have to have a good capital. And the fourth, short-term liquid asset investment over long-term illiquid asset. So you see, sisters and brothers, so you have to differentiate between the short-term liquid asset investment. Short-term means that less than 1 year, for example, and long-term illiquid asset. Illiquid, yeah. So short-term liquid means such as account receivable, yeah, such as cash here, yeah. And long-term illiquid asset, for example, here lands, house, factories, yeah, is illiquid and long terms. So you have to differentiate between these two things. And the third one, come up with the credit risk definitions. Before we continue, any other question concerning the second part, please?
Not yet, sir.
Okay, hopefully you are clear there. Okay, the next one. I just want to summarize and recall what you have learned before the previous meetings. Okay, we go to third one, part about credit risk and definitions. So basically, the credit risk here is part of the liquidity risk, actually, because the credit risk actually is the condition whereby the parties cannot be able to fulfill the financial obligations. Yeah. So the failure of the borrowers to repay the loan or meet debt obligations on time. Yeah. And here we differentiate into 3 parts. Yeah. The credit default risk. Yeah. So here refers to the condition when the borrowers is unable to repay the amount in full, or when the borrowers is already 90 days past the due date of the debt repayments. So you are considered to be default because you cannot pay back. After 3 months, you cannot pay the debt at all. You are bankrupt or you are collapsed. Yeah. So this considered to be credit default risk. And the second one, concentration risk. So concentration risk here is the type of risk arises out of significant exposure of any individuals of group, because any adverse occurrence will have the potential to inflict large losses on the core operations. So concentration means that you are trying to dominate. You have dominant portions. For example, the bank distributed 100% of the money for the lenders, and you obtain maybe more than 60% of the money lended. So this is considered to be concentrated risk. So it's very dangerous because if you are suddenly collapse, so the bank will be collapsed absolutely, because you are holding very big numbers of portions. And the third one is about country risk. Yeah, country risk here is the sovereign state halt the payment for the foreign currency obligations. So usually country risk is measured through the exchange risk, yeah, the exchange movement, the inflations, yeah. If the inflation is quite high and the exchange rate is quite depreciated, so many investors or the foreign investors will look at the country in the danger risk. Yeah. And here is the first, second one. Okay, here is the formula. Yeah. So the formula of the credit risk here, sisters and brothers, usually we use the LGD. Yeah. Loss given default. Yeah. So the loss given default here will show the expected loss, whereby the expected loss here is the PD, probability of default, time expected exposure at default, AAD, times 1 minus LGD. Yeah. Okay, we go to the examples, yeah, to make you more clear. Example 2. Let us assume that EBC Bank Ltd Limited, yeah, has lent a loan of 2.5 million to a company that is into the real estate business. Yeah. According to the bank's internal rating scale, the company has been rated at A. Usually, if you want to lend the money, the company will see your company ratings or individual rating. Yeah. Taking into account the cyclicality witnessed in the industry, the operation, it means the probability of default and loss have given default corresponding to the internal rating is 0.1% and 68%. So probability of default 0.1 and loss given default is 68%. And the expected loss for EBC Bank Ltd based on the given information. Okay, here is the exposure of in default, EAD 2.5 million, probability of default, PD 0.1%. Yeah. Probability of default here range from 0 to 1 probability. Yeah, so the more probability happens, it means that the higher this institution will be bankrupt or default. The lower or closer to the 0, so it does mean that this company or bank is quite sound or resilient. And loss given default, yeah, loss given default 68%. Yeah, so it means that here the loss when the company is default, so the loss if the company collapse will be 68%. Yeah, so the higher is harmful, the lower is good. Yeah, therefore the expected loss can be calculated using the above formula: 0.1 times 2.5, 1080. So expected loss here is $800. So therefore, if the company default or in case that cannot pay back the financial obligations, the loss of the bank will be 800 out of 2.5 millions. Yeah. So from this regard, if you have expected loss higher compared to this one, I mean, it means that the numbers is getting higher and higher. It means that the company is going to be very vulnerable or close to default. Okay, the next one. We go to the operational risk. Yeah, so you have understood now market, liquidity, and credit, and now we're going to the operating. Yeah. So operating risk basically is the risk related to the company's cost structure. So more specifically, it is the risk the company faces due to the level of fixed costs in its operation, such as sales risk, yeah, business risk. Yeah, so the operational risk actually related with the activity, daily activity that the bank or the company conducting. Here the details, operating risk and sales risk. In the case of bank, we go to the credit risk actually. Yeah. Next one. So how to measure the operating risk? So the measurement of operating risk can be done through the application of the concept of elasticity. Yeah. More specifically, we can use indicators such as the degree of operating leverage to an extent the activity is going up, leverage, which is very popular indicators of operating risk. The degree of operating risk leverage measures the sensitivity of operating income to the variation in units sold. It is measured as a percentage change in the operating income divided by the percentage change in units sold. Yeah. So the degree of leverage here, comparing between to what extent your income, yeah, will be accepted or will be received due to your units sold. Yeah. So logically, this doll must be more than one. Yeah. If your doll is equal with one, there is the break even conditions. So between the sold unit and the income is the same, but it should be more than one or profit. But if less than one is loss. Yeah. For example, if we calculated the degree operating leverage for company A and found a value of 3, it means that a company A would experience a 3% increase in operating income for every 1% of growth in units sold. So it does mean that if you have value more than one, so the company or the bank is efficient. Yeah. And here the practical applications, for example, you can just read by your own here, yeah, the case, yeah, and from this case, yeah, you can get the doll 1.5, yeah, 1.5. So it means that every 1% growth, yeah, in a unit sold, it will increase the growth of the revenue of the bank by 1.5%. So the output is larger compared to the input. Efficient. Here are another examples. Yeah, you can just read by your own. Yeah, by looking at the lower fixed cost. Okay, I think that's all, sisters and brothers, concerning with the summarize of the risk related with the banks. Um, Maybe you have any questions or any inquiry. Most welcome, sisters and brothers.
Sir, I want to ask,
Okay, please, Sister Lisa.
can you explain about if the doll is equal to 1, and can you explain about the break even?
Okay, you can just look again to the here, yeah. So actually, DOL here, we have so many measurement. Actually, sisters, not only DOL, but the DOL here refers to the comparison between the input and the output and input actually. So here, the percentage change in operating income could be the output, and here the percentage change in units sold is the input. Yeah. So if you're comparing between output and input, you will get the elasticity. Yeah, elasticity, the dynamic change of output due to the changing in input. If you remember what the microeconomics tells you about the percentage change, yeah, of variable y over the percentage change of the variable x. Yeah. So from on this regard, if you the DOL here, for example, 1, so it means that between the operating income and unit sold here has the same value. Yeah, 1 over 1. So if you have one product sold, so the income you got on the percentage, I mean, yeah, the percentage or the change, the same percentage. So no any difference, either positive or negative. Yeah. So in case if DOL 1, so it could be the break-even conditions. Or in elasticity, we may call unitary elastic. Unitary elastic. But if you have DOL here more than 1, for example, 1.5, so it means that the percentage change in units sold, yeah, has the greater effect to the percentage change in operating income. So 1 percentage change, it will have 1.5 percentage change. So I may say this is the elasticity, elastic, yeah, elastic. And the way around, if less than 1, is the inelastic, yeah, inelastic. So this DOL here basically just want to figure out to what extent our operating risk happens. Yeah. So if the DOL here positive more than 1, so it does mean the banks or the company has been able to manage the operating risk because the company is operating under efficient conditions. If more than 1, if 1 is just 1, yeah, the same 1, the company just considered to be in the stable, maybe stable conditions. The risk is just at the par, yeah. But if the DOL here below 1, so it does mean that the company or the bank is inefficient, or the operating risk is getting larger actually. This is Sister Lisa that I can share with you for more understanding.
Okay, sir. Thank you.
Okay, most welcome, Lisa. Okay, any other comments or maybe you have any experience, sisters and brothers, by the way, please. Any other comments or questions? Please welcome. Okay, if there is no any question, then I don't want to push you to have questions. You can just read again the slide, yeah, through my class, and don't forget to check your my class because based on my observation, next week will be the third test competency, yeah. And for sure, the test competency for the next week will cover the meeting after the second test competency until maybe the final slides that we discussed today. Yeah. Okay, sisters, Baik, Sister Chika, Dini, Erika, Irin, Nisa, Lisa, Noni, Rahma, Raisa, Rizky. Any other question, please? Okay, enough. Okay, if enough, I don't want to push you. Yeah, just please read again. Don't forget to read your textbook. Just match between the explanation that I give here and with the book that you have already uploaded through my class. And next week, we will have another test competency. The details for sure will be informed, but for a while we just follow the class schedule, 9 until 11, inshallah. Okay, that's all. I think, sisters and brothers, for the today class. I wish that you still have the best motivation and high efforts to complete this course. We still have remaining 4 weeks, to complete this course, inshallah. Okay, that's all for a while for today's discussions. Thank you very much for your attention and attending. Don't forget to take your attendance. If I don't put the attendance at all, I will just put the attendance at 9 until 11. Doesn't matter. Yes, because maybe I still have I still not set the attendance list. Doesn't matter. I will set after this 9 until 11 a.m. Okay, that's all. This class meeting is recorded, so I will just put, as always, in my class. Maybe you want to listen the discussion today. That's all for a while. Thank you very much. I close. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Thank you, sir.